Hi, this is Jason, Chief Technical Analyst with ToroAlerts with your weekly market recap for the week ending March 10th. A lot of volatility in the markets this week on the SVB banking collapse, as well as some concerns around Silvergate, a big banking firm in the crypto space. So we've got one bank that's completely gone insolvent, that was a big financier for the tech space, and Silvergate being a big financier for the crypto space under a ton of pressure, also looking like they may be in pretty big trouble as well. So starting to see some banking issues both in the traditional markets as well as the crypto space, and that really pulled down a lot of price action for the week. So let's dive into the charts and take a look at what we're seeing. Starting out with the total cryptocurrency market cap, we're pretty big drop off that 1 trillion level that we were at not too long ago, now sitting at about 915. We did get a time to mark 9 signal indicating at least a short-term bottom. We'll see if that ultimately can hold. Our cryptocurrency market cap is back up above the 200-day moving average just slightly. So we'll see if that can ultimately hold going into next week. Jumping over the Ethereum chart, also put in a time to mark 9 signal. We did bottom out right around the 200-day moving average in Ethereum as well. Saw a little bit of a rebound today. We're recording this on the 11th. We'll see if we can get any follow through on that, or if this is just a little short-term bounce before we potentially head lower. I think with all the concerns around Silvergate, I'm personally being pretty cautious with any cryptocurrency trades at the moment. And then jumping over to Bitcoin, we are back down below this descending wedge pattern. When we zoom out on this, we can see that we've been in this descending wedge all the way back to 2021. I think it was November when we peaked in the top end of the Bitcoin price, and it's been a pretty steady decline since then. We finally broke out of that descending wedge pattern in January, and so that definitely got some people excited about a potential bullish breakout. A lot of times when we do get that, we will come down and retest those levels, which we did a bit and then failed a little bit in February. Got right back up above that. We've once again now failed off of those levels, so we really haven't seen a successful retest of that descending wedge pattern. So we want to see price action for the bulls get back up above that descending wedge pattern, potentially retest successfully that trend line, and then hopefully we'll see Bitcoin head higher. But again, with this concerns around Silvergate and some other issues in the traditional markets as well, I think it's definitely a good plan to be a bit cautious right now with your longs, and I wanted to see a clear rebound in the coming week. Otherwise, I'll be pretty neutral to bearish for the crypto space. Take a look at the traditional markets. The S&P 500 also saw some huge downside pressure to close the week out on that SVB banking news. Got back down below this significant trend line. We've been in this descending channel for all of 2022, and then we ultimately broke out late January, early February. Also got people pretty excited for the markets. We actually did come down and successfully retest, at least in the short term, that trend line. Started moving up to the upside at the beginning of March. Definitely got a lot of people, including myself, excited that maybe we're going to start to see a breakout in March and see a pretty strong March in the markets. But that SVB and some of the Fed talk around potentially higher rates all kind of put a rein on that party, and we are now back down below this significant trend line, also below some key anchored VWAP levels. So this anchored VWAP level at about 386 is off of the COVID lows, and so I think that's a very significant VWAP to keep in mind. We are closing below that on the week, just slightly though, just below 386, and the anchor VWAP is currently sitting just above 386. So there's been one thing that's been pretty common ever since the market started selling off in late 2021, early 2022, is we've seen a lot of kind of whipsaws off of key trend areas, and so this I would say is a pretty significant level at that 386. So if we do see a whipsaw back up above that in the coming week, then I think that'd be pretty positive for the markets, and wouldn't be too surprising, as we tend to see a lot of those as we've seen the market selling off over the last year or so. So if we can get that whipsaw back up, maybe there'll be some hope for a rally still in the month of March. But if we stay below that 386, especially going into next week, if we close next week below that 386 level, then I think the hopes of a March rally are very likely over, and could even potentially signify that what a lot of people were hoping was potentially a new trend change off those October lows could ultimately be dying out. So that 386 level is a key area I'm watching on the S&P 500. And then when we take a look at the breadth measures on the S&P 500, another reason I'm a bit concerned about this recent price action is we saw our 200 or stocks above their 200-day moving average drop below that 50 level. That's a key level that I like to watch, and typically when we're below 50% of our stocks in the S&P 500 below that 200-day moving average, that's pretty rarely a bullish sign, and so we definitely have broken down below that level. We've also broken down the previous lows on our breadth indicator, which was back in looks like December of probably middle of December of last year, and that was right about 48 or so percent of the S&P 500 stocks above their 200-day. So definitely seeing a bit of a reversal here. So unless we get a big whipsaw or we rip back up above that 50% level, if we stay below 50% on the S&P 500 stocks below their 200-day moving average, then I think that's definitely quite a bit of a bearish signal there. And we're also seeing a big breakdown in the S&P 500 stocks above their 50-day moving averages. That's collapsed all the way down to just below 18%. So we're not just seeing sector-specific sell-offs, we're really seeing a broad-based sell-off across pretty much all sectors right now. Take a look at the triple Qs, our NASDAQ. NASDAQ's actually held up, I would argue, somewhat well, especially compared to the S&P and the Dow Jones Industrial Average recently, but also saw some pretty bearish price action this week. We're at a pretty key level. We are below the 50-day and the 200-day moving averages on the triple Qs. Again, a lot of whipsaws we've seen over the last 12 to 18 months, and so we need to be cognizant of that. I wouldn't necessarily be going aggressively short at this point, but this is also not a super bearish or super bullish looking chart either. So we would definitely want to see price action on the triple Qs get back up above the 50 and 200-day moving averages to start getting more excited about going long again. If we stay below those levels, then I think that's a pretty bearish signal for the markets and for the NASDAQ specifically. However, we are above this descending trend line that we were in all of last year, so we could in theory drop down. We've got an anchored VWAP at about 282, which is another significant level I'll be looking for if we do head to the downside, and potentially even retest this trend line here. So I don't think all hope's lost for the triple Qs quite yet, but also looking somewhat bearish recently on the NASDAQ. And then take a look at our Dow Jones Industrial Average, looking a little worse here as we were kind of sitting in this bull pennant for quite some time. We kind of started forming this bull pennant late December and really going into all of 2022, looking for a potential breakout to the upside. That clearly didn't occur. Now we've seen a pretty clear breakdown off of those levels. We're below the 200-day moving average as well, and we're just down and basically retesting just about to this trend line that we were stuck in for all of 2022. So if we are looking for some hope here, we do have that anchored VWAP position at 315 as well as that trend line. So if we can hold that level and possibly bounce, then maybe we do get a bit of a rebound off the Dow Jones Industrial Average. But if we see a clear breakdown below 315, 316, that anchored VWAP level, then I would say that'd be pretty bearish for the Dow Jones Industrial Averages. Take a look at the transports, similar story. Looked like we were breaking out briefly to the upside, and then that had a pretty quick reversal where it not only broke down below this trend line here, but also broke down below this Fibonacci extension level, which is about 14,360. So we really want to see the transports get back up above that level if we're looking for some upside opportunities. And as long as we're below 14,360, I'd say that's pretty concerning and pretty bearish for the transports. And then take a look at our Russell 3000, also looking pretty bearish here. We came back down, broke out of this trend line that we were in for all of 2022. On our Russell 3000, broke out of, these are weekly candlesticks here, so we broke out towards the end of January on this chart. Started seeing some bullish price action, came up and retested that center channel line, and then ultimately started coming down. Just a couple weeks ago, it was looking somewhat promising as we came back down and retested that trend line. Then next week, we ultimately tested it again and then kind of took off to the upside. So literally just 1 week ago, things were looking somewhat constructively bullish there. But then on that SVB banking news, we just really saw a huge reversal. It was already kind of starting to head south off the tough Fed talk and talking about a potential 50 basis point rate hike. but then we really started to see price action move the downside on that banking news. And so seeing it not hold that trend line is definitely concerning. We also saw it break pretty definitively below the 21-week EMA and SMA levels, so which is also pretty bearish. So unless we can get again a big whipsaw back to the upside, then I think that's a pretty concerning chart here on the Russell 3000, and pretty hard to be super bullish unless we get those back up above those price levels. Currently that's sitting at right around about 2280 or so on the RUA. And then taking a look at our new highs, new lows list. This is also a pretty big trend change that we've seen, which is also making me feel pretty bearish for the overall markets. For one, we saw the 10-day moving average roll over and cross that trend line, and so that's looking pretty bearish. We also saw the new highs really deteriorate this week. Just about a week ago or so, we were seeing new highs starting to accelerate a bit, and then we really have seen new highs to just completely deteriorate this last week. And on top of that, we also saw new lows really start to accelerate. And so in some of those previous corrections we had, and even during some of that volatility in February, we were seeing just very small increases in the new lows, and new highs weren't completely breaking down. But now we're really just seeing a huge breakdown of the new highs, and we're starting to see a big acceleration in the new lows as well. So definitely not bullish looking information here either. Jumping over to large caps, Russell 1000, also looking pretty bearish as we were sitting in this descending wedge pattern for all of last year, broke up above it, and then came down and retested it a few weeks ago, just like the Russell 3000, and then ultimately saw a big failure this week, dropping back down below this trend line and also below the anchored VWAP level, which was our COVID low VWAP at about 213. So if we're below 213 on the IWB, pretty hard to make a bullish case for large caps at this time. Also looking at the Russell 2000, the IWAM, also saw a big breakdown in small caps as well. Small caps actually sold off pretty aggressively. I think one of the reasons for that is there's a lot of banking exposure in the small cap space, and so they got hit pretty hard, I think, on the banking concerns this week. So we did see a big move down. We came down and retested that 173.50 level, and that is a pretty key area of a pretty key trend line to watch for. And so we have so far held that somewhat to close the week out. But that doesn't necessarily mean that it's going to hold for sure, so we'll need to see some follow through next week and see if we're looking to get bullish on the small caps. We definitely would want to see that 173.50 hold on the IWAM. And then we take a look at our relationship ratio chart. This is our large caps divided by our small caps, and we can see that we've had not a super strong trend, but definitely a pretty clear upside move in small caps relative to large caps. And we've also seen that relationship break down this week, and now we're starting to see small caps underperform, which also is not looking super great for the markets. One interesting thing we are seeing that still looks pretty constructively bullish is growth is still outperforming value. And so in the past, when we've seen growth outperform value, that has tended to be a good sign for the markets, especially if we just are looking at the last 12 to 18 months or so. And that's still holding up. We're not seeing a massive breakdown there. So if we're looking for any kind of kernels of hope in the market right now, this is probably one chart that looks somewhat constructively bullish. But just because growth is outperforming value doesn't necessarily mean the markets are going up. So it could just be that growth is getting beat up less than value right now. And so still seeing some strength out of the growth sector for now, but again, doesn't necessarily mean the markets are definitely going to head higher from here. And then jumping over to the bond market, taking a look at our TLT on the top panel, IEF on the bottom panel, which is our 7 to 10 year. On the top panel, the 20-year, saw a big move up. Both of them actually gapped up on Friday, and so things are starting to look pretty interesting for the bond market, I would say. For one, we ultimately didn't sell off super aggressively, and we ultimately held that 99.50 level or so, and then looked like we put in a pretty strong base and then a big reversal and a gap up. So as long as that gap holds and we don't see it break down below about 102.50 on the TLT, and I think that's a pretty bullish looking chart here for our bonds. And so I'm already back into TMF, which is a levered bond ETF that I like trading just to get a little bit more upside exposure. and this is actually looking like a pretty good entry point as long as we're staying above that 102.50. Then I think we're looking like we got some upside opportunity in the bond market right now. I would argue we'd at least get probably back up to this 109.50 level or so, which is where we topped out the last couple times. But I'm also thinking that there's a pretty strong chance we could actually break out to the upside. If we see 109.50 pop to the upside on TLT, then I think there's a real strong chance that we start seeing the bond market move to the upside and could really actually start to see some nice performance out of the bond trades, which I typically don't trade in a good market, but we're clearly not in a great market right now, and so got to look for those opportunities wherever they are. And right now, from the long side at least, the bond market is looking like one of the few places that aren't really concerning at the moment. And then we take a look at our sectors. The last 5 trading days, this is a great example here. We can see out of all the sectors we tracked for the last trading week, the only sectors in the green was our TLT bond and our gold shares on the GLD. Everything else was in the red on the week. Ag was the least. The best sector that was in the red on the week at about 1.5%. Also seeing consumer staples down only about 2%. And then when we look down at the worst performing leaders, we ultimately saw natural gas breakdown, so that the hope of that trade to the upside is ultimately kind of falling apart. Once again, nat gas is down at the bottom of the leaderboard, down almost 20%. But as we scroll through this, we can see that a lot of sectors are down pretty aggressively on the week. We're seeing multiple sectors down, 8 to 12%. Seeing a lot of other sectors down anywhere from like 4 to 7%. So just a real tough week in the markets for anybody that was super long, and not a lot of areas to go hide and protect yourself from the long side. So definitely a rough market this week for the long side. Take a look at the VEU for our global markets minus the United States. Ultimately saw price action break down below that 52 level. However, we are still holding that 50-week moving average right now in the VEU, and so if we can hold that, there could be some hope left for the global markets. But I would imagine that if we see the U.S. continue to sell off, we'll probably see the global markets follow suit. So we'd be looking at that, looking for support if you're looking to go long on the international markets at that 51.25. But if we see a breakdown below those levels, then I think we've got to be pretty cautious there too. Jumping over to the oil space, oil's still holding up kind of in this range. This does sort of look like a bear flag at this moment. However, the DIA looked like a bull flag, and that ultimately broke down, so this could clearly go either way. But we want to see a clear direction out of this, which we haven't gotten yet. This is our weekly candlesticks on our oil prices, and we're really stuck in this tight range. And so we want to see a clear breakout to the upside if we're going to get long on oil and energy stocks, which we haven't seen yet. Or we want to see a breakdown below that, probably about 72 or so, if we're looking for the next leg lower in our oil prices. Jumping over to the commodity CRB index, once again we are down at a pretty key level on the CRB index, which is right around 265, we'll call it. And this has been a level where we've looked like potentially we're set up for a possible breakdown in the CRB index, and then each time we've gotten to these levels, we've seen a big whipsaw back up to the upside. So we'll see if that happens again. Next week will be definitely give us some good information. If we see a breakdown below that 265 level on the CRB, that would definitely be a bit of a trend change to the downside. And we did see obviously some downward pressure off of our highs back in 2022, but we've really been kind of chopping around sideways for really multiple months now, and so we kind of don't have any clear direction on the CRB index at this moment. And if we do get that break below 265, then it does look like we'd be heading lower from here, and then that would be looking for about a 242, 243 for the next target to the downside on the CRB index. But definitely got to see some follow through below that 265 level next week if you're looking for a short opportunity down that 243. Taking a look at precious metals, the GLD had a pretty good finish to the week. Did see some volatility in gold this week, but ultimately Thursday and Friday we saw some nice follow through to the upside, getting back up above this anchor VWAP level and just about up to this trend line at about 174.50. But things are starting to look pretty good for gold, and I think there's a good chance that we'll be seeing the gold prices head to the upside here in the short term. When we look at the gold futures, similar story. We saw what looks like a double bottom put in at about 1812 or so on our gold futures, and we're starting to hit higher from here. However, we are right up against our 50-day moving average, so we want to get real excited about the next leg higher. We'd probably want to see gold futures clear that 50-day, which is about 1875 right now. Looking at the silver chart, the SLV also saw some move to the upside, at least on Friday, but we are still stuck below this trend line, which has kind of been our descending pattern here ever since we had that gap down back in early February. So we want to see a breakout above about 1920 or so on the SLV before we're probably looking for our next long trade on silver. And when we take a look at the silver futures, we also look like we are trying to put in a bottom right around this 1995 level, and but we are still below our 200-day moving average. So looking for a break above that 200-day moving average on the silver futures to kind of confirm a move to the upside, which would be about 21 or so per ounce on the silver futures. And then we take a look at our interest rate. So our 3-month interest rate started spiking up above a trend line earlier this week. Started to look like we were maybe going to ultimately start heading higher on our 3-month, but then we saw a bit of a reversal. Didn't see a complete breakdown and get back down below this trend line, but we've come back down and retested it. So next week, if we're looking for rates to head lower, we'd like to see that 3-month roll back over underneath that trend line. Currently sitting at about 4.83%. Our 2-year had a big move to the downside, so that was definitely a clear reversal on our 2-year. Started seeing a spike up above this slightly descending trend line. Then we did see a breakout above those levels, but then and also got above 5% on the 2-year. But then the Thursday and Friday saw a big reversal, not only big reversal off the 5% level, but also a big reversal getting back down into this channel as well to the downside. And so as long as we don't see the 2-year pop back up above about 4.75%, then I think the most likely trend on the 2-year is to the downside. 10-year also seen a huge rollover on Thursday and Friday. Looked like we were potentially putting in a top on our 10-year. We did see a brief spike above 4%. But then we saw a big reversal the very next day, tried to retest that 4%, couldn't get back above it, and then saw a pretty big plummet Thursday and Friday. So it looks to me like the 10-year top is in for the time being, and as long as we can stay below this trend line, it looks like the most likely outcome on the 10-year is to continue to head lower. Same story on the 30-year. Ultimately tried to get up above 4%, couldn't really close above 4% on any of our daily candlesticks, and then started seeing a reversal, came down and tested this trend line, and then ultimately that was trying to hold up as support, and then it had a big failure on Friday, dropping back down to about 3.7% on the 30-year. So overall, it looks like the overall trend in interest rates is rolling over, and looks like rates are heading to the downside. And when we take a look at our euro-dollar futures, when we take 100 and minus the euro-dollar future, that gives us a indication of where the Fed funds rate is likely headed. And so right now, that would imply that we're sitting at a likely 5.5%. But just a few days ago, earlier this week, we can see that it was pricing in more of a 5.75%. So we've already essentially erased a quarter point rate hike off of this chart, and so and we've also seen rates roll over to kind of confirm that. And so I think there's a strong possibility that the rate spike that we saw recently and throughout the month of February is likely over, and we'll at least see there's some sideways price action or some downside price action in our interest rates, at least in the short term. And then take a look at our dollar chart. Dollar chart was starting to spike up as well, getting above that 105 on the Dixie. Looked like there was a pretty strong chance we might get up and retest that 200-day moving average, but we saw a rollover to finish the week off. But a lot of those Friday losses kind of reversed a bit, and so still kind of unclear which direction we're heading on the dollar. But if we zoom out a little bit more, we can kind of see in this trend line that we have clearly reversed from our previous highs, and as long as we stay within this descending trend line, I think the longer to medium term outlook on the dollar is still to the downside. And even if we do see a bit of a spike, I'm looking for that 200-day as a key area of potential resistance, where we potentially roll over from there, or maybe we don't even retest it and we ultimately just continue to head lower. But it's not looking like we'll see. If we do see any kind of a dollar spike, I don't think it'll be long-lived, and I think we'd at least hit resistance at that 200-day, or at least the top of this trend line. I think the most likely outcome on the dollar is to the downside for at least the short term. Take a look at the high yield corporate bond ETF. Another chart we like to look at for kind of overall market health. We did see a big reversal on this week as we were trying to get back up about that 75 level. However, we are still above this trend line that we were stuck in all of last year. So that's kind of a key area that I'm watching on this chart. If we see an ultimate breakdown where price action gets back below this trend line, then I think that would be another even a bigger bearish signal right now. But so far it looks like the HYG is holding up okay, and we'll just need to keep a close eye on it next week and see if we get any kind of reversal here, or if we ultimately see HYG continue to follow through to the downside. And then take a look at one of our another one of our market health indicators. This is investment grade bonds divided by the 7 to 10 year bond. When we see price action close below the 50-week moving average, that's tended to be a pretty bearish signal. When we went through this chart, going all the way back to the great financial crisis of 07-08, and just about every single time we see price action fall below and close below that 50-week moving average, that's been a pretty bearish signal. And not necessarily guaranteeing a crash, but definitely not bullish price action on this chart. And we actually just close at that 50-week moving average on this chart. So key area to watch next week. If we see price action follow through to the downside and we see the weekly candlestick close below 50-day, that'll be pretty concerning for the bulls. And then for a confirmation signal, I like to look at the EMA and the SMAs, which are 13-week, which essentially represents a quarter. And on that 13-week EMA, which is the white line, and then the 13-week SMA, which is a purple line, those haven't crossed yet. But if the EMA crosses the SMA on this chart, then that would be the kind of confirmation I'm looking at to essentially get out of any potential longs. I don't have a lot of longs right now, but any longs that I do have, I would definitely be closing out, because if we see that price action close below the 50-week, as well as see the EMA cross the SMA, there's just no way I can view that as as bullish price action, and be really a pretty strong indicator of the market's likely heading lower across the board. And then we take a look at our put call equity ratio. Saw a huge spike this week, almost getting up to about 1.5. Anything above 1 is elevated put buying protection, and so we're seeing a big spike in defensive puts being put on the market, and so definitely looking a bit bearish off of that as well. And then we also saw a massive VIX spike this week. We really have been stuck below 25 on the VIX, going all the way back to, let's see, the last time we actually had a close above 25. Looks like that was all the way back in November of last year. So we've spent multiple months below that 25 level, and while we didn't close above the 25 level, we saw a massive spike on Friday, dang near pushing 30, and then ultimately closing just below 25. So if we see this rocket up back up above 25 next week and start seeing some price action close above there, that would also be a pretty bearish signal. But really, even just seeing a spike off of that, we started the week out at about 18 on the VIX and closed at about 25, so still a big increase. We're still seeing the VIX above our 200-day moving average. So this is definitely, at least in the short term, a trend change over what we've seen over the last few months. And we'll want to see if there's any follow through. If the VIX stays above that 200-day moving average and gets above 25 again, definitely not a good sign for the markets. Go ahead and wrap it up with a trade opportunity on the TLT. Like I said, there's not a lot of longs in the stock market that I like right now with all the risk out there. But I do think, and I've been talking about this really all year, that the bond market, I think, is going to be a great place to put some long trades on. Looking at even some levered trades on that, trading TMF for some levered upside. Also looking at some call options for the bond market, because even in a strong bond market, they still move a lot slower than the average stock, and so I like to look for a little extra leverage on that when I'm trading this. Really probably not putting any calls on in the market quite yet for the TLT. I'd really want to see price action break up above that 109 or 109.50, which would get us clear above this what was a previous double top. It's possible we maybe triple top this and then roll over from here. That's why I'm not putting on any big bond or any calls right now in the market. But if we see price action clear that 109.50 on TLT, then I think there's a pretty clear path to start to see some accelerated moves to the upside on TLT. And if this Elliott wave count is accurate, we'd be looking at about a 127.75 or so upside price target over the next few months on the TLT. But we first got to contend with that double top trend line, which is right at about 109, 109.50 or so. But I am already in this trade on at least a TMF levered long, as we did see that nice gap up on big volume, and so I think that 102.50 or so is a great area of kind of stop loss area. I've got my stops set just below that 102.50 area. As long as we're staying above 102.50, then I like the bond market and TLT long. At least getting back up to that 109.50 area. We'll be watching that closely if we do retest that, and then hopefully we'll see some follow through and actually get a clear breakout above that. And if we do, then I think at least 120, 121 seems in the cards, pretty likely, and then ultimately we could be seeing that Elliott wave count up to 127.75. So thanks for tuning in. Make sure to download the ToroAlerts app on the App Store. We've got one for stocks and one for crypto. It'll help you navigate these volatile markets. And you can also check us out at ToroAlerts.com. See you next week.